Hello and welcome to the latest news update on Canary News. In a recent legal development, a Delaware judge invalidated Elon Musk's $55 billion pay package at Tesla after a shareholder contested its excessiveness. This decision, marking Musk's first major court loss, raises questions about the future of his wealth and the fate of Tesla. If the ruling withstands a potential appeal, Tesla's board will need to devise a new compensation proposal, as Musk's original plan was deemed the largest executive compensation in history. The shareholder challenge, upheld by Delaware Chancery Court Chief Judge Kathleen McCormick, focused on inadequate disclosures by Tesla directors regarding the 2018 executive compensation package and the required performance benchmarks for Musk. McCormick also identified conflicts of interest within the board's consideration of the pay plan. In her 200-page ruling, the judge criticized Musk's involvement, stating that he essentially conducted a self-driven process, adjusting its course as he saw fit. The result, according to McCormick, was an unfair price, leading the plaintiff to request a recall through litigation. Musk, who is consistently ranked as one of the world's wealthiest individuals due to his Tesla stake, hasn't exercised any options from the compensation plan. Despite his unconventional approach, Musk has typically prevailed in court battles, such as the shareholder suit over the SolarCity acquisition. Richard Tornetta, the Tesla shareholder leading the legal challenge, argued that the board failed to act independently when crafting Musk's pay package, allowing him to shape the details to his liking. The absence of adversarial negotiations between Musk and the board regarding the grant size was a notable omission in the process, as highlighted by the judge. Musk's defense failed to justify the necessity of the historically unprecedented compensation plan, claiming it was crucial for motivating transformative growth. However, the judge asserted that Musk's ownership stake was sufficient motivation, and the board overlooked the fundamental question of whether the plan was necessary for Tesla to retain Musk and achieve its goals. During a recent earnings call, Musk emphasized his desire for a larger stake in Tesla, framing it as a matter of leadership rather than financial gain. The future remains uncertain, with Musk yet to decide on appealing the ruling or Tesla's board formulating a new pay package. Musk's extensive wealth, much of which he pledged for his Mars ambitions through SpaceX, hangs in the balance, with Musk viewing his compensation as a means to fund the costly endeavor of colonizing Mars. Moving on to news from another tech giant, Microsoft Corporation has reported its most robust revenue growth since 2022, with a surge driven by increasing interest in new artificial intelligence products, leading to a resurgence in spending on cloud computing. In the second quarter ending on December 31st, revenue soared by 18% to reach $62 billion, and profit amounted to $2.93 per share, according to the company's statement on Tuesday. Analysts surveyed by Bloomberg had, on average, anticipated per-share earnings of $2.78 with sales hitting $61.1 billion. While there are indications that incorporating AI into key products like Azure, Office, and Windows is proving successful, some investors appeared to expect more, causing a slight dip in shares during late trading before recovering some losses. Hargreaves Lansdowne analyst Sophie Lund-Yates noted in a client note that Microsoft delivered a healthy set of results but fell short of meeting the market's high expectations. Chief Financial Officer Amy Hood revealed that AI had boosted Azure's growth rate by 6 percentage points. Going forward, the company anticipates increased customer usage of basic services like storage and computing power due to growing interest in AI products. Microsoft aims to position itself as the preferred platform for running AI models. Mark Mordler, an analyst at Sanford C. Bernstein & Company, observed that 6 percentage points of Azure's growth were attributable to AI, indicating a potential slowdown in the rest of Azure. Commercial cloud product revenue saw a 24% increase, reaching $33.7 billion. Microsoft's corporate version of Microsoft 365 Copilot, an AI assistant for Office programs, was released widely on November 1st. Microsoft Office's cloud service for business users surpassed 400 million paid customers in the quarter. In the more personal computing unit, sales reached $16.9 billion, slightly surpassing analyst projections. Global personal computer sales saw a 0.3% increase in the quarter, signifying stabilization in demand after 2 years of decline. Azure Cloud Services sales demonstrated a 30% gain, surpassing analyst expectations. Microsoft's CEO, Satya Nadella, has been driving the company to become an AI powerhouse, evidenced by a partnership with startup OpenAI, a move that contributed to Microsoft's market capitalization exceeding $3 trillion. Xbox content and services revenue saw a substantial jump of 61%, with the inclusion of Activision Blizzard Incorporated, acquired in October. Xbox recently appointed a new president for the Blizzard unit as part of Microsoft's efforts to integrate acquired businesses and stimulate growth in gaming revenue. The company has invested $13 billion in startup OpenAI, propelling Microsoft into a leading position in the race to develop applications enabling users to generate fresh content from their data and web-scraped information. While management changes at OpenAI briefly stirred attention in November, analysts suggest it likely had little impact on Microsoft's AI revenue. Investors are now awaiting detailed data and forecasts from Microsoft regarding the timing and impact of AI contributions to its bottom line. Continuing the topic of earnings from another tech giant, Alphabet Incorporated has reported its fourth quarter revenue, showcasing a strong end to the year. Excluding partner payouts, sales surged by 15%, reaching $72.3 billion in the 3 months ending on December 31st, surpassing analysts' projections of $71 billion. Net income stood at $1.64 per share, exceeding the Wall Street estimate of $1.59 per share. However, the core search advertising business's revenue in Alphabet fell slightly short of expectations, landing at $48 billion, missing the anticipated $48.15 billion, leading to a 6.5% decline in shares during extended trading. This setback comes amid increased uncertainty for Google's search engine, facing new competition as generative AI, exemplified by ChatGPT and companies like Microsoft and OpenAI, gains prominence. Google's advertising revenue, a significant part of its earnings, faces volatility, prompting concerns about the company's AI-focused plans. Investors, initially bullish on Alphabet's AI initiatives, are now seeking clarity on when AI technology will significantly impact earnings and revenue. Analyst Evelyn Mitchell-Wolfe noted that as Google faces increased volatility in its cash cow, investors may grow cautious. While Google has been integrating AI technology into its products, concerns persist about its pace compared to competitors like Microsoft. Alphabet has been investing in AI, releasing its potent large language model, Gemini, last month. Despite efforts to catch up, Alphabet has faced criticism for perceived delays in capitalizing on the market shift toward AI. CEO Sundar Pichai has emphasized AI and other priorities, leading to operational scrutiny and layoffs in various areas. Google's cloud unit saw a notable operating profit of $864 million, surpassing analyst estimates. Despite trailing behind Microsoft and Amazon in cloud computing, this marks Google Cloud's first full year of profitability. However, Alphabet's push into AI has increased costs, with capital expenditures rising by $2.96 billion, mainly attributed to AI investment. The company's capital spending in 2023 is expected to be significantly larger than the previous year. Alphabet's diversification efforts beyond its core business include YouTube, reporting $9.2 billion in revenue, slightly above analysts' estimates. Other bets, the Moonshot unit featuring projects like Waymo and Verily, generated $657 million in revenue but incurred an operating income loss of $863 million, less than analysts' expected loss of $1.3 billion. The Google Network business, responsible for serving ads on various internet platforms, experienced a 2% revenue decline to $8.3 billion. This sector, a historical weak point for Alphabet, is set to be a focal point in an upcoming antitrust trial later this year. Moving on to automotive news, Toyota has issued a do not drive advisory for around 50,000 older U.S. vehicles, urging immediate recall repairs due to potentially defective Takata airbag inflators. The affected models include the 2003 to 2004 Corolla, 2003 to 2004 Corolla Matrix, and 2004 to 2005 RAV4. The recall is a response to the ongoing global issue of Takata airbag inflators, linked to over 30 deaths, including 26 in the US, and hundreds of injuries. The inflators have been known to explode, releasing metal shrapnel inside vehicles. This recall, one of the largest in automotive history, brings the total number of Takata airbag inflators recalled in the US to over 67 million. The RAV4 recall concerns the driver's airbag, while the Corolla and Corolla Matrix recalls are related to the front passenger airbag. Some Corolla and Corolla Matrix vehicles are also part of a second recall related to the airbag deploying without a crash. The move follows a trend of do not drive warnings issued by automakers for vehicles equipped with Takata airbag inflators after fatal incidents. While Toyota has not disclosed whether the advisory is prompted by a specific incident, the National Highway Traffic Safety Administration has not commented on the recall. The broader context highlights the persistent challenges in managing recalls and safety concerns associated with Takata airbag inflators, emphasizing the gravity of the issue for the automotive industry. That is all the time we have for today. Tune in again tomorrow for the latest news update. Remember to smash the like button and subscribe to our channel.